Welcome back to Up to 5 Minutes, where you gain more knowledge in the real estate world in under 5 minutes. I'm Alton O'Shields, a loan officer with Rate here in Philadelphia.
And I'm EricJForte, a licensed real estate agent with KW Empower in Center City. Alton, you work in mortgage lending, and we always hear mortgage interest rates, the terms. Sometimes I think it's helpful to go back to the beginning and understand where we started and how we got here. So what is a mortgage anyway?
That's a great question. A lot of people think that a mortgage is a loan. It's actually not. It's a document that says the house is the collateral for the loan itself.
Which is why when you're buying a house, you've got two main documents there, a note and a mortgage.
Exactly, yeah. The mortgage doesn't even have any of the terms of the loan on there. It's basically just saying that you understand that the house is that security for the loan.
So Alton, from my understanding, Philadelphia has an interesting role in mortgages.
That's right. Actually, mortgages originated here in Philadelphia in the United States. They were created in 1782 when we had the first national commercial bank. Its sole purpose was originally to do business for and with the government, but within a year it turned into a fully functioning lender. That's
really interesting, and I'm sure 18th century mortgages are a lot different than what they look like today.
They are completely different than what they look like today. The loans were actually, in today's standards, pretty predatory. They were 50% down, they were usually interest-only payments, and then there was a balloon payment at the end, which means you had to pay off the rest of the 50% of principal at a set date. Today, that would not happen at all, but if you think the interest rates are tough now, they were also much higher back then.
So things were definitely very different back then. When did things start to change to where we see the modern use of mortgages?
Things definitely took a change during the Great Depression in the 1930s. In the 1933, they passed the Homeowners Loan Act, which created the Homeowners Loan Corporation. And essentially what this group did is they traded bonds to banks to acquire defaulting or mortgages that were in distress. And then they took those loans, extended out the term payments, and gave them a lower interest rate to help homeowners. They basically provided home refis with lower interest rates and bigger long terms to make the payments more affordable, and that's kind of what led to what we see today.
And that Homeowners Act was the predecessor to what everyone calls today Fannie Mae, right?
Correct, yeah. A couple years later, they created Fannie Mae, and then also the FHA as well. And that's really when things took a lot more serious role. You had more rules and regulations coming into the homes, because previously during the Great Depression, mortgages were defaulting at a 30 to 40% rate, which created a huge economic collapse and a huge housing collapse as well. So the FHA and Fannie Mae came in, helped regulate it, and bring some standard and consistency to the mortgage industry.
And the creation of Fannie Mae is what led to the 30-year fixed mortgage loan, right?
Correct. Up until that time, 15 and 20-year were more popular, but the 30-year was helping combat the issues with affordability that everyone was having. There was also a huge surge in the housing market as well during the 40s to the 60s when people were coming back from World War II and using their GI money to purchase these homes. So you had a huge increase into the housing market, more affordable loans, longer term loans, and more people able to use their GI money to buy these houses. It really created consistency and a standard into the industry at that point in time.
And a drastic increase in home ownership, right?
Correct, as well. It really changed it from being just a housing tool to an investment and way to gain money and to build a portfolio of wealth.
So what I'm hearing is that the one constant when it comes to mortgages is change.
That's right. It's changed multiple times throughout the history of loans and mortgages, but those change always tends to be good for the consumer, and there's more protections than ever right now for consumers and home buyers. So even with the new changes, it's not something to worry about. There is great protection in there for you. Thanks for joining us again at Up to 5 Minutes. Hope we learned a little bit about loans and mortgages and the history of the United States. Make sure that you comment any topics that you want to learn about. We want to hear from you and make videos that are specific to what you want to know.
And don't forget to follow us on Instagram, LinkedIn, and YouTube, and we'll see you next time.